What's good, traders? Today we're breaking down one of the most underrated concept of any ICT or smart money concept strategy, which is the candle close. Everybody loves to talk about FPGs, breaker structures, market structure shifts, even breaker blocks or like turtle soups or whatever. But here's the truth that nobody tells you is that none of it really matters or means anything until the candle closes. Okay, wicks do the damage and bodies tell the story. That's what I always say. If you can understand that, you'll stop getting faked out mid candle and you'll start actually trading with real confirmation and an actual idea of what's going on. But let me walk you guys through every example, right? So, which is FBGs, breaker structures, liquidity sweeps, breaker blocks, whatever. I'll even talk about candles and shit. So, let's start with fair value gaps, okay? So, price trades into a gap, right? If it enters into a fair value gap and mid candle, it looks like a rejection, most traders will jump in immediately. But the price can and most likely will end up closing straight through the imbalance at some point, and that FVG is not invalid, right? Got disrespected. So anyone who entered mid candle kind of just got smoked, right? So now let's see the kind of why do you want to wait for an FVG with the candle close. So let's say we take this FVG that's right here, right? Let me make sure I'm full screen first, or I'm not full screen. All right. So let's say we have this FVG here, right? Not filled, whatever, no candle has been in it, right? If we get a candle that goes in it, a lot of people what they're gonna do is they're gonna put a limit order right at the FVG, right? And then when the candle enters the FVG, it'll trigger their limit, even if the candle just ends up going straight through it. Now, what you want to do is you want to wait for the candle close. Even if it wicks back down, you want to wait for it to close because it could always come back up. Okay? A candle closing inside an FVG to me did not respect it. It's not an inverse FVG just yet, but it did not respect it. It's kind of like a let's see what the other candle does type of moment. But to be completely honest with you, if the first candle that enters the FVG closes inside, usually I will not use that FVG, even if the second closes outside of it. Now, do not trade the wick reaction, guys. Trade the actual body confirmation, okay? Let me find you guys an example really quick. This is going to be just a very quick example here. Let's say we wanted to go short off of this fair value gap here, right? And let's just say we're saying, okay, we want to go short here due to being in a downtrend, big fair value gap, big move down. We let the trade play out here. The candle taps into the gap but closes inside of the gap. This right here to me is not good. And as you guys can see, we kind of just end up going right through it, right? Whereas this candle in the bullish fair value gap, you can see entered it, but did not close in it. And look at the one that holds, right? So that just goes on to show you guys that if you have a candle reach into a fair value gap, always wait for the candle close on the right time frame, right? So if it's a 5 minute fair value gap, don't go down to the 1 minute and see a 1 minute candle close below and then enter. You have to wait for the next 5 minute candle to actually tap into it. And sure, sometimes it's gonna cost you some RR, but honestly, in my experience and from what I've been journaling so far in my 6 years trading career, it's way better for your overall R gain at the end of the year because you're going to save so many trades as well. Now it's the same thing but with structure, right? Mid candle price rips above a short-term high or whatever. Everybody's thinking break a structure, breakout, whatever, and goes long. But the candle closes back inside the range. Now that wasn't a break of structure, right? It was just a liquidity sweep. On the other hand, if you see a candle close beyond that high or that low, usually that's kind of a good confirmation of displacement, especially if you get a fair value gap within. That's when a market structure shift becomes valid. The wig did the damage, it ran stops, but the body tells a story, right? Did we actually shift structure or did we just grab some liquidity and snap back down? Now, it's also important to note that highs are also tethered to their time frames. So, let's say we're talking about this 15-minute time frame high here, let's say, right? I'm just taking this one as an example. If we have a candle go above it like this, I'm looking for a 15-minute sweep of this. And if this high is also an hourly high like it is, I'm waiting for an hourly high. Now, let me show you guys something here, okay? This, let's say this 1 minute high here, let's say this 1 minute high here will not show on, let's say, a 15-minute chart, right? It's just mid candle. It's like it's random. So with this right here, price breaking above is a 1 minute break of structure, a 1 minute market structure shift, but it would not be a 15-minute market structure shift or break of structure. Do you guys understand what I'm saying? What I'm trying to say is, let's say you have a high, right? Let's say I'm gonna take a random high for now. Let's say we're talking about this high, right? And we want to know if it's a liquidity sweep or not. You have to be on the time frame of the high. So let's say it's a 15-minute high and we sweep it on a 15-minute candle. Now that's a liquidity sweep. Okay, you can then take this trade to the intermediate low. All right, like you see here, it kind of worked out. Now, if you go down to the 1 minute, maybe a candle closed above that line, but it still doesn't count, right? It's just noise at this point, and actually no candle closed above here, which is a bad example, but you guys see what I mean, right? If you have a 15-minute high and you want to see if it's a break of structure or a liquidity sweep, you have to be on the 15-minute. If you guys are on the 1 minute, then you can just stay on the 1 minute, right? Let's take, for example, this hourly liquidity sweep that we have here back into this 1 hour for value gap, right? Now we have a massive, massive sweep of inducement right here, which happened at these equal highs, which ended up sweeping all this buy side liquidity here, right? On the 1 hour, these are 1 hour highs that got 1 hour swept, okay? Now, if you go down some lower time frames, you want to confirm the sweep early on to try to catch a trade, you can look for inverse for value gap. Now, that's a whole other thing, but what I'm trying to show you guys is that on the 5 minute, we most likely had a candle close, let's say, right? We had a bunch of candle close here. That doesn't mean it's breaking structure. These are hourly highs, okay? This is just an hourly liquidity sweep. You have to wait for the 5 or 15-minute confirmation and before knowing. Now, if you get a 1 hour close below here, that's enough to enter on itself on the liquidity sweep, right? But if you want to be more of a day trader, more precise on the lower time frame, a little refined, then you can go down to the lower time frame, know that this is a fake breaker structure, it's actually a 1 hour liquidity sweep, and wait for some bearish confirmation to take this reaction off the 1 hour for value gap. Does that make any sense to anyone? Basically, the simplest I can kind of explain it is that let's say you have hourly highs and the next hourly candle goes up and closes back down, you're kind of betting that the next hour will go lower. So you're looking for reasons to go short on the lower time frame, right? So let's say you're kind of looking at this liquidity sweep here that just happened. The candle closes right here. You enter short, right? Stop at the liquidity sweep high because technically it shouldn't go higher than that. And you target whatever low you can, right? This is a 1 to 3 RR trade and it ended up working out as you guys can see. But my point here is that you didn't really actually need the lower time frame. But if you want to day trade, you want to actually trade fast in and out, then it's good to know. So what you're trying to do is you're trying to size where your hourly and your FAR is going to go using liquidity sweeps and whatnot. And from there, you can kind of guess where the lower time frame is trying to go and find your entries this way. It's kind of how I generate a bias in the morning. So if off of these 1 hour highs, I see this 1 hour liquidity sweep right there, I know that we're going lower. This video kind of shifted here a little bit. I'm trying to explain to you guys why you need to wait for a candle close, and I just gave you guys a whole model, but whatever. It's fine. Now, here's where it gets a little spicy, right? Just breaker blocks. A lot of traders see a level get broken by a wick and think, oh, that breaker is invalid. But if you understand closure, you know that wick just created an A plus unicorn setup, okay? So let's say, for example, price wicks below a short-term low, right? Then closes back above inside that breaker block. That breaker now becomes a premium setup called a unicorn setup. Why? Because the wick ran all the stops and the body, the close, short absorption. That combination, which is pretty much like wick damage and body confirmation, is the highest probability setup, okay? So let's say, let me look for one. So a unicorn setup basically looks like this, right? You have a trend or whatever, and then you get a sweep, and then a sweep back above, confirming continuation of the trend, and it keeps going up, okay? So you get your liquidity sweep down here, you get your trend continuation up here, and you enter on this wick here that gets created into, like, let's say a displacement fair value gap here. Now I'm saying this very quickly because I have a whole video on that. Okay, and then you place your entry here. Now this is a unicorn setup. Oop, wrong one. Now this is a unicorn setup, okay? Now, usually an A plus unicorn setup is called a unicorn setup because it'll come in with a wick. Now let's use that same goddamn wick because this would have been a valid trade setup. This happened NYAM session. This should have been a trade that everybody took, okay? So, or everybody trades ICT. So we have a trend, okay? Our trend, which has gotten broken here with this market structure shift here. Oh, wrong one. With this market structure shift right here is now bearish, okay? From there, you expect this to happen, right? Now, you want a unicorn setup, you need this to happen. Once this happens, you're looking for continuation down, right? So you're looking for this. Now you get this wick inside this fair value gap right here. Sweep, sweep down, bang, right there. If this shit retraces back in here, unicorn setup. Truthfully, the unicorn setup happens here, but we do not trade at this time. Now, thankfully, we get this hella unicorn setup right there, which is just the wick. The body closed below. Again, same day, but it happens every day. You just have to find on the time frame that it happens, right? Stop here, TP at the low, same 3.6, whatever. GG, good trade. Here's the deeper truth, guys. Every wick that you see on a closed candle was once a body. Okay, so when you're live in the market, that wicks kind of looks like momentum and it looks like displacement. So traders tend to jump in because it feels real in the moment. But when the candle closes, all that momentum is erased and it prints as a rejection. That's why so many traders say, I backtest fine, but I struggle on live. Think about it, right? In backtesting, you only ever see closed candles, really. The whole story is already basically told. You never see the fake pushes, the spikes, the moment where a body looks strong before it closes weak. And that is why backtesting sometimes can feel easy or clean. You're forced to wait for closure because that's all you're shown, right? But live, you're watching the story basically being written, okay? And if you don't have a discipline, you'll react to the noise, forgetting that the wicks are just basically unfinished bodies, okay? Now that's the trap people enter on what looks like displacement, only to realize that by the close, it was just a wick, right? So what do? The rule is simple, guys. In FVGs, don't trade unless the candle closes respecting the imbalances. In structure, don't call BOS or MSS until the body closes beyond the level, otherwise it's a liquidity sweep. In breaker blocks, understand that the wick runs the liquidity, but the close is what validates the block. And always remember that the wick does the damage, but the body tells the truth. If you align your trading with closure instead of reactions, you trade what's confirmed, not what's just in progress, right? And that is why patience pays, guys. In backtesting, you naturally wait for the close. In live trading, you have to choose to wait. The market will tempt you mid candle. Okay, it'll make a wick look like a body because that's what it is. A wick was once a body. So when you're watching it live, that body might turn into a wick when the candle closes. Okay, but if you sit on your hands and wait for the candle to finish, you'll instantly cut out way, way, way too many bad trades that you're taking. Okay, the next time you're about to jump in, ask yourself, did the candle actually close where I needed to? Or did the candle that I needed to close at all, right? If not, don't take the trade. Wait, be patient. Patience pays, okay? Wicks lie, bodies tell the truth. Trade the close, not the noise, guys. So, yeah, basically that's all I kind of wanted to say today. I love you guys so much. Thank you guys for 300 subs, by the way. I love y'all, and I'm really happy to be doing this with you guys. Don't forget to like, comment, subscribe. Drop down any video ideas you want in the comments. I'll do them every single time, and I love you guys. Have a good one. Peace.